All right, welcome to Talk Tickers. Today, we are diving deep into Academy Sports and Outdoors. That's ticker ASO. And wow, their Q2 earnings report was a real head-scratcher, a fascinating mix of good and bad news that really put investors in a tough spot. So here's the deal. On the one hand, you've got some seriously good news. Academy hit this huge milestone, their first positive comparable sales growth since 2021. That's a big deal. But on the other hand, the bad news. They missed their profit expectations. So you have this classic conflict for investors. What do you pay attention to? The promising sales or the disappointing profits? Well, the market definitely made its choice. It reacted, and it reacted fast. The stock got hammered, dropping a steep 7.5% on some pretty heavy trading volume. And that right there is the central question we're going to tackle. Why the huge disconnect? Why would the market punish a company that just hit a major strategic milestone? Okay, let's get into the nitty-gritty here and look at the actual numbers. The revenue miss, honestly, it was pretty slight. Not really the end of the world. But that earnings miss, a 20-cent miss per share, that's a different story. That's significant, and you can bet Wall Street wasn't going to just brush that aside, no matter how good that positive comp looked or how amazing that nearly 18% jump in e-commerce sales was. So to really get what's going on, we have to look at both sides of the coin. Let's start with management's take on things. From their perspective, the turnaround plan is absolutely working, and that positive comp is Exhibit A. So let's break down what they say is driving this success. They've basically got this three-pronged attack that's really starting to pay off. First up, they're going all in on e-commerce. Second, they're opening new stores, expanding their physical reach. And third, and this is a big one, they're locking in some key partnerships with huge brands. And that focus on digital? Oh yeah. It's working. We're talking e-commerce sales rocketing up by almost 18%. What's really important here, though, is the acceleration. They grew 10% last quarter, and now they've jumped to nearly 18%. That tells you that whatever they're doing, it's gaining steam fast. And the CEO, Steve Lawrence, he was pretty direct about it on the earnings call. He called it a step change improvement. You know, he's not just saying, hey, we had a good quarter. He's saying this is a turning point, a fundamental shift in their performance. It's the story they want investors to hear. We've turned the corner. And this is super interesting because it shows us exactly who is driving this growth. They're seeing really strong double-digit growth in traffic from higher income customers, people making over 100 grand a year. And that increase was so strong that it completely wiped out the drop-off they're still seeing from their lower income shoppers, which, by the way, is also starting to slow down. So a really key shift in their customer base. Okay, so that's the bull case, the sunny side of the street. Now let's flip the coin and look at the other side of the argument, the part the market seems to be fixated on. This is where things get a little cloudy. And this brings us right back to that million-dollar question, doesn't it? I mean, sales are looking up, e-commerce is on fire, they're attracting wealthier customers. It sounds like a great story. So why on earth did the stock get clobbered? The answer, my friends, is all about the bottom line. It's about profits. That earnings miss, it was no fluke. It was caused by a few key things. Rising costs from all those new stores and tech investments, margins getting squeezed by stuff like theft, or shrink as they call it, and higher shipping costs for all that e-commerce. And then you have the big scary macro fears, like tariffs and whether the consumer is going to keep spending. Yeah, and let's talk about SG&A for a second. That's just a fancy term for selling, general, and admin expenses. The key thing to get here is that these rising costs aren't just waste, they're the price of growth, the money they're spending on new stores and new tech. It's that classic saying, you gotta spend money to make money. But for investors who are laser focused on this quarter's profits, that can be a really tough pill to swallow. You also have to put this one-day drop in context. I mean, look at this. Before this report, the stock had been on an absolute tear. It was up over 32% in just 3 months, crushing the broader market and other retailers. So you have to wonder, how much of this sell-off was really about the earnings miss, and how much was just people cashing in their chips after an incredible run? All right, so that's the push and pull. With all that in mind, let's look ahead. What is management saying about the future? Their updated guidance for the full year is really where we can see how they plan to navigate all these headwinds. And this is pretty bold. You'd think after an earnings miss, they might get a little cautious, maybe lower their expectations, but nope. They did the opposite. They actually raised the bottom end of their full-year forecast for sales, comps, and earnings. That's management basically saying, yeah, we see the challenges, but we're confident the good stuff is going to outweigh the bad. And they also address the whole tariff situation head-on. They laid out a whole playbook for how they're going to fight back against those potential cost increases. We're talking about everything from working with their suppliers to share the pain, to actually moving production to different countries. They seem to think they've got enough levers to pull to mostly cancel out that headwind for the rest of the year.
Okay, so that brings us to the final verdict. How do you weigh these two completely opposite stories? You've got the bull case with a real, tangible turnaround, and you've got the bear case with very real cost pressures and macro risks. It's time to put it all together and make a call.
So let's just lay it out. The bull case is all about momentum. The sales growth is real, the comps are finally positive, e-commerce is accelerating, their strategy is clearly working. The bear case, though, is all about the cost of that growth. Margins are under pressure, SG&A is rising, and they're facing external risks from tariffs and their reliance on that high-income shopper. It's a classic growth versus profitability debate.
So after weighing everything, we're landing on a market perform reading. Look, the company is doing a lot of things right. You can't deny the execution on their growth plan, but the risks are just too balanced right now. The rising costs and the uncertain economy are real headwinds that keep us from getting more bullish. The potential is definitely there, but so is the risk. And really, that leaves us with the one question that every investor has to answer for themselves. Was this big stock drop just a short-term overreaction from a nervous market that will eventually catch up to the great sales story? Or are these rising costs a warning sign of a much bigger, more persistent problem with profitability? How you answer that question is going to determine the future of this stock.
And just a reminder, this is not financial advice.